Artificial intelligence (AI) has rapidly become one of the most significant drivers of innovation and growth in the global economy. Companies involved in AI development have seen meteoric rises in stock prices over the past decade. However, the underperformance of AI stocks, particularly after periods of rapid growth, can have significant ripple effects across the U.S. stock market. As more investors become exposed to AI-related companies, the performance of these stocks holds weight in shaping broader market trends. In this video, we explore the top 10 effects that AI stocks' underperformance can have on the U.S. stock market. 1. Reduced investor confidence in tech sector. AI stocks represent a substantial portion of the tech sector, and their underperformance can erode investor confidence in tech stocks overall. When AI-related companies, often perceived as the most innovative and forward-thinking, fail to deliver on expectations, investors may become more hesitant to invest in other technology sectors. This could lead to widespread sell-offs in tech stocks, affecting the overall market sentiment. 2. Impact on venture capital investment. Venture capitalists often view AI as a high-reward sector. A significant decline in AI stock performance could prompt investors to reassess their funding strategies, pulling back from AI startups and ventures. This shift could result in less capital available for emerging AI companies, slowing the development of new technologies and innovations. The venture capital ecosystem could shift toward more traditional industries, potentially stifling the growth of AI innovations. 3. Weakened market indexes. AI stocks are often a large part of major market indexes, including the S&P 500 and the Nasdaq 100, which is heavily weighted toward technology stocks. When AI stocks underperform, it can drag down the performance of these indexes. For example, if tech giants with AI operations like Google, Microsoft, or Tesla underperform, their decline can contribute to broader market downturns, affecting retirement accounts, pension funds, and institutional portfolios that track these indexes. 4. Disrupted sentiment for growth stocks. AI stocks are often associated with growth investing, where investors seek companies with high potential for expansion. If AI companies underperform, it could cause a shift in sentiment away from growth stocks toward more stable, value-oriented investments. This could lead to a broader trend in the market, with investors prioritizing companies with proven profitability over those with high growth potential but uncertain future returns. The result could be a rebalancing of portfolios toward established sectors like energy, healthcare, and consumer staples. 5. Shift toward safer investment strategies. When AI stocks face underperformance, investors may start to feel that riskier, high-growth investments aren't as rewarding as they once thought. This shift could lead to greater demand for safer, more conservative investment strategies, such as bonds or dividend-paying stocks. In turn, the demand for AI and tech stocks could decrease further, creating a feedback loop that further dampens the performance of these stocks and their impact on the broader market. 6. Pressure on AI companies to reevaluate strategies. Underperforming AI stocks can place significant pressure on companies involved in AI development to reassess their business strategies. As stock prices fall, companies may focus more on short-term profitability rather than long-term innovation. This could stifle the drive for new AI breakthroughs or force companies to delay projects in favor of more immediate financial stability. This shift could have a long-term impact on AI advancements and future growth potential. 7. Increased market volatility. The volatility of AI stocks, often tied to speculative investments and frequent price fluctuations, can result in broader market volatility when those stocks underperform. When large tech firms with significant AI investments experience major losses, it could cause a ripple effect that affects broader market stability. Volatility in the AI sector could create a domino effect, causing instability in various asset classes and leading to unpredictable market movements. 8. Altered investor risk tolerance. When AI stocks perform poorly, investors may re-evaluate their risk tolerance. Many investors, particularly retail traders, might have flocked to AI stocks in the hopes of making quick profits. Underperformance could cause them to reduce their risk appetite, influencing their willingness to invest in other speculative sectors. This shift may result in a more conservative investment climate across the board, with fewer high-risk, high-reward stocks being traded. 9. Lowered expectations for AI's market disruption. A slowdown in AI stocks could also lead to a recalibration of expectations regarding the industry's potential for disrupting traditional sectors. If AI companies failed to meet revenue and growth projections, it could diminish confidence in the transformative impact AI was expected to have on industries like manufacturing, transportation, and healthcare. Lower expectations could reduce market enthusiasm for future AI ventures, affecting the broader tech sector's growth prospects. 10. Regulatory scrutiny of AI companies. Underperformance in the AI sector could draw increased regulatory scrutiny from government bodies. As AI companies face mounting pressure to deliver on their promises, regulators may be more inclined to investigate practices related to data privacy, ethics, and market manipulation. Increased scrutiny could slow down innovation, disrupt business models, and add an additional layer of uncertainty for investors, further exacerbating the market challenges. The underperformance of AI stocks can have significant ripple effects throughout the U.S. stock market, influencing everything from investor confidence to the future of tech investment. As AI continues to shape the future of industries across the globe, the challenges faced by these companies, especially when they underperform, highlight the fragility of emerging markets. Investors and businesses alike must stay informed of the potential impacts, adjusting their strategies and expectations to mitigate risks associated with the fluctuating nature of AI stock performance.